All right, home buyers, I've got exciting news for you. If you're putting down less than 20%, your mortgage payment just got cheaper. Mortgage insurance rates have dropped. Mortgage insurance just got cheaper. So if you're putting 3%, 5%, 10% down, stay tuned. I'm gonna show you how cheap mortgage insurance has got over the last few years. Before I jump into it, if you like straightforward mortgage, real estate market content from somebody who's a mortgage broker who deals with thousands of people every single year, real estate agents, home buyers, conversations I'm having around mortgage and the market, I share that on this channel. I share it with you to help educate you so that you can make more informed decisions. If that's your cup of tea, please consider subscribing, share this video, like this video, comment on this video, much appreciated. So I'll jump right into it. If you are a buyer who's putting down less than 20%, and let's face it, a vast majority of the people I work with are. Some people have the luxury of putting 30 or 40% down or buying with cash, but for the vast majority of people, especially first-time home buyers, you're looking to get in a home and you're putting down 3 or 5%, maybe 10%. Good news. As a mortgage broker, I'm always excited when I can offer the best of the best when it comes to interest rates, when it comes to terms and fees and mortgage insurance, and an announcement on the mortgage broker side where lenders are making it more affordable for you. And I'll explain it with numbers because I think numbers work better than anything else. Before I do, mortgage insurance over the years has continued to get cheaper and cheaper. And we're talking about mortgage insurance on conventional loans. So I know it's on all FHA loans and it's a flat fee that is the same, it remains the same, but for conventional loans, for the lenders that I'm sending business to, it just got cheaper. And it's got a lot cheaper over these last 3, 4, 5 years, where I've been watching it. So if you have a 780 credit score, and let's start with excellent credit. I just give some examples at 740 and 700, but you've got a 780 credit score, you're a first-time buyer, you're only putting 3% down. This is a $400,000 purchase, and so 3% down equals $388,000 loan amount. Your factor is 0.33. That's only $106 a month. If you happen to qualify for Home Possible or Home Ready, it's even cheaper. It's a 0.3 factor, $97. Before I show you everything and get into this, I'm going to show you what that factor means. It's basically saying $388,000 loan, right? 3% down on 400. Let's take 388 times that by 0.0033. Right there. And that equals $1,254 a year. You divide it by 12, and that's how you get $104.50. I might have overestimated. Some of these are estimates, but it's even cheaper, $104.50, right? And that's what the factor means. So on the 0.2 factor, you do the same thing. Loan amount of 380 times it by 0.2%. That's an annual. Divide it by 12, and you get $63. So as you can see, a $400,000 purchase, you might be in an area where it's even cheaper. So your mortgage insurance is even cheaper. Or unfortunately, you might be in California where it's more expensive and it's higher. But 3% down, even if you don't qualify for Home Possible or Home Ready, you're going to get a 0.33 factor, 106. I think we just did the calculation, realized it's probably 105, but either way, cheap. 5% down, even cheaper, $63 a month. 10% down, even cheaper, $48 a month. As your credit score goes down, it gets a little bit more expensive, but still, it's reasonable. Let's imagine this scenario, right? You're putting 5% down on a $400,000 purchase, so you're borrowing $380. Your mortgage insurance is $95 a month. I can tell you, without going back and looking at historical data, that was over $200 5 years ago. In 2016, when I was writing loans, in 2015, when I was writing loans, mortgage insurance was more expensive. It's continued to come down. Another thing to mention that you want to know if you're a first-time home buyer is it's not the same with every company. If you're working with a company that might be captive and they're, in an environment where all their loans go to the same company, maybe they've got 2 or 3 different MI companies to choose from, but in general, they might be higher, right? And so I'm going to insert a little bit of advice right now. If you are talking to somebody and they're quoting you and you're doing 3%, 5%, 10% down, anything that requires mortgage insurance, make sure you know the mortgage insurance number, right? Because that plays into it. What I've seen sometimes, a quick example here, and this is a good lesson that I think is worth teaching. You get one quote from one lender that says 2.874% rate, and you've got principal, interest, taxes, insurance, and then mortgage insurance. And your total payment, $2,025. This is a total guess, total random scenario, right? You might see 2.75 and say, oh man, this lender's offering me 2.75. With everything else being the same, if the mortgage insurance is $55 per month, then you're saving a little bit on rate, but you're paying more in mortgage insurance. Maybe it's $2,055 a month, all in payment, right? So one, you got to be sure you're looking at both and total payment. Two, you got to make sure that everything else is apples to apples. Property taxes, homeowners insurance, those shouldn't change from lender to lender. But mortgage insurance can, right? 2.75 might be a worse deal. It's especially a worse deal if there's fees baked in, right? You got to make sure it's apples to apples on fees as well. So I won't belabor that, but make sure those are the questions you're asking and you're really looking at things apples to apples. As a mortgage broker who talks to hundreds of people every week, I can tell you with absolute certainty, people who are comparing are more often than not comparing apples to apples. They're doing themselves a disservice because they really don't know what to look for. I've made videos in the past where I talk about how to compare apples to apples. Even with that information, I feel like people can get confused. I've got people calling me that say, hey, this lender offers no third-party fees. They've got to be the best, right? No, they're offering you a much higher rate. And that increase in rate is what's covering the third-party fees, right? So anyhow, that's another video for another time. Back to mortgage insurance and how excited I am about this. Even if you're on the lower end, you know, conventional, when you're above 700, you're almost always going to be conventional versus FHA, choosing conventional. And if your credit's not perfect at 700, you're still only paying $152 a month, putting 5% down. So this is just a quick video to say lending could not be better. Interest rates are at all-time lows. Mortgage insurance are at all-time lows. Sure, your market might be competitive. Sure, your market might have less listings that it did a couple years ago. But once you do land a home, right, you're able to get the best financing terms out there. If you have any questions at all, reach out to me and my team. We're happy to help. Matt at mattthemortgageguy.com. If you're outside of California, I want to connect you with my U-Mortgage team who's licensed all over the country. greatmortgagebroker.com. A quick 6 steps there, and we'll connect you with a team that can lend in the area that you're looking to buy if it's not California. If it's California, again, Matt at Matt the Mortgage Guy. Hopefully this was helpful. Let me know if you have any questions. Comment down below. I'll try to get back to those, or send me and my team a message if we can get you pre-approved and get you rolling. Happy to help. Talk to you soon.